So, should we be watching Canada more than the US when it comes to this rate cut cycle? When it comes to the direction of the economy, the health of the economy, where this world is going in terms of jobs and inflation, just like we got the inflation report just yesterday from Canada coming in weaker than expected, should we be watching Canada more closely than the US? Because just a week back, a couple weeks back, we were talking about a 50 basis point cut in the US and how we're going to see these aggressive jumbo rate cuts in the US. But then we got data, like the non-farm payrolls data report, the jobs data report, coming in higher than expected, especially it's the US last CPI inflation report coming a little higher than expected, basically throwing cold water on the idea of 50 basis point rate cuts in the US, coming anytime soon at least. Now, we also heard from certain Fed members come out and saying that, going slower, not being too reactive, and cutting rates too aggressively too fast is important. We are also heard from some Fed members say that that they want to, they're willing to go back to stopping the rate cut cycle if inflation picks up again. There were risks with the shipping industry, the labor market there, the shipping industry, the unions, basically freezing their work, which could have cascaded into bigger problems when it comes to inflation and prices. But they're back to work now. Things are resolved, right? And talks about oil prices. Are we going to start to see a pickup there? Could we see a pickup there? And if things start to move up higher in oil prices and gasoline, could we start to see the Fed slow down or maybe stop its rate cut cycle, right? So all of these potential variables, which basically at the end of the day led to the markets now perceiving that, the Fed's not going to do the 50 basis point rate cut. They're going to go with the 25 basis point one instead, more likely, unless things drastically pick up or something changes. We also heard that it was more Powell's idea of doing a 50 basis point rate cut rather than many of the other FOMC members out there. They leaned more towards maybe a 25 basis points rather than the 50 basis points. Now, could that 50 basis points be because the US is trying to catch up with like Canada? Because Canada was the first one back during the rate hike cycle. They were the first one to hike rates. Compared to US versus Canada, Canada was the first one to cut rates also, right? So we tend to look at the US, which is still important. I'm not saying don't look at it, and I'm not saying that, completely disregard and ignore it. According to the data, jobs and growth is doing very well in America. But then when you look outside of America, especially when you look at, let's say, China, for example, that's pumping all this liquidity and money into the system, cutting rates, they're in trouble. But let's not pick China or any of these other countries. Let's pick a G7 country like Canada, a neighboring country to the US like Canada, who is seeing some weakness in their economy, and not only seeing weakness in their economy, but seeing a quite sharp drop in its inflation report. And also seeing the probabilities move up higher and higher. We're talking about now a 60-70% probability of a 50 basis point rate cut next week in the Bank of Canada's meeting next week, right? And what did I mention? What did I say many times on this channel before? When you start to move towards an area of aggressive emergency cuts, jumbo rate cuts, right? This is just the start. you tend to see panic or this recession or crash come in around that time or a couple months later. And we're starting to see that in Canada first. And could we see the same thing in other countries like the US? So, in other words, should we be focusing on Canada first rather than the US because they seem to be the leading country when it comes to this rate cut cycle and this lower inflation and the weakening in the economy? Could Canada be the catalyst for something drastic to happen that could also maybe cascade into other countries? Maybe, maybe not. But one thing's for sure that we've been seeing since the beginning of this rate hike cycle that we saw back in 2022, them being the first ones to hike rates, to now rate cut cycle, them being the first one to cut rates, to now them being potentially the first ones to start doing these jumbo 50 basis point rate cuts. And then we see US kind of following, tagging behind. So let's take a deep look into Canada's inflation report that they reported yesterday, because that could give us some sort of information, some sort of idea of where maybe the US and other countries might be heading towards. Now, there's elections happening in the US. There's a lot of theories out there that you could throw out that, the reason why the jobs data and the US is looking strong because, it's manipulated, or, the revisions are not being counted properly, the way they calculate certain things, the government jobs have increased drastically, etc., etc. Although maybe some of those arguments may be true, maybe not. But I do believe that maybe after this election, maybe in the next year in 2025, we will probably start to see more of a clear path of where maybe this economy, the US economy, might be heading towards, which will hence dictate what the Fed will do when it comes to its rate cut cycle. But until then, while all this mess is happening, let's focus on Canada and see what's happening in Canada. So let's talk about this Canadian CPI inflation report. So we saw that yesterday the inflation report came in lower than expected. The headline report came in at 1.6% versus the expected, this is the year over year number, versus the expected 1.8%. The core number year over year came in at 1.6%. The number before was 1.5%. When we look at the month over month number on the core side, came in at 0, no change. When we look at the headline month over month number, coming in negative 0.4%. And that's what's causing that headline year over year number that the media and the news will report. That's what's causing the main number that everyone looks at, causing that to drop drastically, right, to that 1.6% level. Now, when you look at this headline number, it looks like it is dropping quite sharply here. When we look at a few months back, we were sitting around, in the summer months, 2.9%, right? In a span of 4 months, we went from 2.9% down to 1.6%, right? So we're seeing the slash of the headline number come down lower and lower. And if we see the previous number coming at 2% versus this number coming at 1.6%, a drop of about 0.4%, we're seeing that sharp decline, right? And if you look at past history with the CPI report, look at 2008, 2009, 2020, 2000, 2001, right? We tend to correlate and see these sharp declines whenever we're in that recession, crash kind of area, right? Now, this is just the start, right? Anything can happen, definitely. but I wouldn't be surprised to see that sharp decline escalate further, especially heading into 2025 next year, right? We could see that headline number potentially even go into negative territory, right? So we could see that deflation scenario, which people would be happy and think that, oh, that's a good thing, but not necessarily. Why? Because that tends to coincide with that recession, with crash, with jobs being lost. So we're not far from that, where we went from 2.9 to now 1.6%. And if you see during COVID, those big slashes in the inflation, right, in the, let's say, March 2020, 2.2% to then dropping all of a sudden to 0.9% and then negative 0.2%. What I would want to watch with this 1.6% that we're seeing today is that number go below 1%, right? We want to see that CPI number, let's say, go below 1%. Maybe it's sitting at 0.9%, 0.8%, 0.7%. Then you know, okay, we're heading towards the zero bound and even into negative territory. It's very likely that deflation scenario. And again, that coincides, like I said, over and over again in history, when you look at history, to that hard landing scenario, to that recession, to the job losses, to those unemployment rate going up higher, right? That coincides with it. Obviously, this is all a probabilities game. Could this be a one-time scenario where it doesn't happen? Sure, but I would give those odds a very low odds. I would say it would be higher odds of that hard landing scenario. Now let's dive deeper into this report. I talked about the numbers here. Let's see what Statistics Canada has to say about the CPI report. So CPI rose 1.6% year over year in September, so it's still up, right? But lower than the expected, lower than the previous numbers that we've been seeing before. So it rose 1.6% year-over-year basis in September, down from 2% gain in August, the smallest yearly increase since February 2021, plus 1.1%. The main contributor to this lower number is basically gasoline, which is negative 10.7% compared to August negative 5.1%. All items CPI excluding gasoline rose 2.2% in September, matching the increase since August for this measure. So biggest contributor is those lower gasoline prices, which is important because if that starts to pick up, then we could see the headline number pick up as well. But if it doesn't, gasoline's coming down, even with all the geopolitical tensions that's happening out there. The fact that gasoline is coming down is also a telling sign that there's fear of weaker demand coming down, aka hard landing, recession. Now, gasoline prices fall year over year. On a monthly basis, gasoline prices fell 7.1% in September, following a decline of 2.6% decline in August. September decline was driven by lower crude oil prices, like I mentioned, amid increasing concerns over weaker economic growth. So just exactly what I said, right? The lower prices has to do with fears of weaker demand, economic growth, even though you've got all these geopolitical tensions happening around in the world, war, etc., etc. Now, rent. Prices for rent increased at a slower pace in September, rising 8.2% year over year, following 8.9% gain in August. Rent price growth slowed most in Newfoundland, Labrador, New Brunswick, and British Columbia. So rent, shelter component, you can expect that to still remain sticky until we get the cascading effect, until we get that crash scenario. Then we can see those rent and those prices come lower and reflect that into the CPI. Now, consumers are paying less for air transportation. Makes sense, right? Especially if your essentials are still so expensive. Consumers paid less year over year for air transportation in September. Also makes sense. Everyone's back to school, back to work, right? End of the summer travel. Canadians continue to face higher prices at the grocery store. Prices for food purchased from stores rose 2.4%. So still, your essential food items at the grocery stores are still expensive. The same growth rate as in August. This is the second consecutive month that the grocery prices increased at a faster pace than headline inflation. While prices declined on a year-over-year basis for some food items such as seafood and other marine products, they've seen some declines there where marine products were minus 4.9%, nuts and seeds minus 0.9%, fish minus 0.3%. The others continue to increase and remain elevated, such as fresh and frozen beef, like plus 9.2%, edible fats and oils plus 7.9%, and eggs, to start off your breakfast if you have eggs in the morning, plus 5%. Additionally, prices for food purchased from restaurants rose at a slightly faster pace in September, plus 3.5%, compared to August, plus 3.4%. And side note, tuition fees increased at a slower pace also. So, again, let's cover all the items overall. Food, up 2.8% for September 2024. Shelter, up 5% for September 2024. Two of the major components in the CPI report, two of the major items that are essential to life that are still high up and sticky, right? Shelter component, the rate still higher. That's going to take time for it to come down. Food, with geopolitical tension, supply chain maybe still disrupted there. War that's happening, the tensions between the West versus East, that might have a factor there as well, keeping food inflation higher. So more money is going towards those areas of life because they're the essentials. Now, will we see these prices come down? Many factors come into play. Like I said, deflation, crash, recession, hard landing. Maybe trade war, trade balance gets better. Potentially that could have a play. But, if it doesn't, and if we're in this new regime, this new world of, trade balance being disrupted, the West and the East conflict continuing, which I think it still will, regardless of recession or not, I think that could still be stickier long term, right? The other components, household operations, furnishings, and equipment, minus 0.2% for September. Clothing and footwear, if you're into clothing and footwear, guess what? Lucky you, minus 4.4%. Transportation, we have minus 1.5%. Health and personal care, plus 3.1%, higher for healthcare services. Recreational, educational, reading, no change. Alcoholic beverage, tobacco, recreational cannabis, plus 3%. Now, what's going to be interesting is that as this all plays out, the labor market in Canada, as we've been seeing also with its unemployment rate moving up higher and higher and higher, showing signs of that recession and hard landing, as that number starts to creep up even further and starts to spike up higher, it'll be interesting to see how that plays out in this CPI report. Again, we could see that move lower as people potentially lose their jobs, try to find a second job, part-time job, whatever the case may be, and really reduce their spending. And then we could see the true cascading effect. So overall, my point of mentioning this, it was important to recognize and see that Canadian CPI report. Important to recognize that the market is expecting a potential 50 basis point rate cut next week for Canada. Important to recognize that the Canadian yield curve is steepening. Those bond yields in Canada are moving down. The market's pricing in further rate cuts, jumbo rate cuts, the 50 basis point rate cuts. Inflation is coming down. However, yes, sticky components, food and shelter is still there. We're at 1.6% headline. We're close to that zero mark. We're getting closer. We're not that close, but we're getting there. Could see negative, could see deflation, right? We've seen Canada being the leading country when it came to the rate hike cycle, also with the rate cut cycle. When you're looking at all these Western countries there, and now we're seeing it being the leading one potentially with the 50 basis point rate cut, which we could see next week. I think we should keep an eye on this and continue to keep an eye on this because we could see how other countries, other Western countries out there react the same way, and how we could see that maybe play out in the US. So pretty interesting there. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and we'll talk soon or later. Cheers.